Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at energy fuels.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis. For years, energy fuels was, seen as a pure play uranium producer, very sensitive to the spot price.
Right.
But the core thesis today it's fundamentally changed. We're looking at a critical minerals platform that has built one of the most significant competitive moats in the entire U.S. supply chain.
And when we talk about that moat, we have to start with the White Mesa Mill. It feels like more than just a facility. It's like a national strategic asset.
It is.
But how vulnerable is the company to, say, a single-site operational risk? I mean, that one mill is the linchpin to their entire domestic dominance, right?
That is the critical point. Yes, White Mesa is the center of their universe, but its dominance comes from regulatory exclusivity, which is very hard to disrupt. It is the only licensed and operational facility in the United States capable of uranium conversion and purification, specifically for commercial-scale production of HLE.
HLE. High-assay, low-enriched uranium.
Yeah.
That's the cutting-edge fuel for the next generation of advanced nuclear reactors.
Exactly. And the small modular reactors. It's the technology the U.S. government is banking on to meet, future energy goals.
So that licenses everything.
It is. The license to handle HLEU at scale is a regulatory and infrastructure barrier that is almost impossible for competitors to replicate quickly. This isn't just about digging up rocks. This is about being the bottleneck processor for the country's nuclear future.
And we're seeing that in the numbers.
We are. You can see how vital this is becoming. HLE production generated $9.1 million in revenue in Q1 2025, which is nearly triple the results from Q1 of 2024. That moat is generating accelerating cash flow.
What I find fascinating, though, is that even with this sort of near monopoly, management is pushing so hard on diversification. They're explicitly moving beyond uranium and committing substantial capital to rare earth elements, REEs, and heavy mineral sands.
It's a deliberate strategic hedge. They want to reduce that single commodity volatility, but more importantly, they are responding to massive geopolitical tailwinds.
The need for a non-Chinese supply chain.
Exactly. The U.S. needs secure, domestic, critical mineral supply chains. The whole strategy is to turn the White Mesa Mill into a sophisticated, multi-commodity processing hub.
So they can just use the existing infrastructure and licensing to process these other critical elements.
Precisely. They are advancing the Phase 2 REE separation circuit expansion right there at White Mesa.
Yeah.
But the diversification isn't just domestic.
Right, the international acquisitions.
They're acquiring mineral properties globally for HMS, which contains titanium and zircon for high-tech manufacturing. They picked up the Koala project in Kenya, Toliara in Madagascar, and Donald in Australia.
The goal being a more consistent, non-cyclical revenue stream to stabilize things.
Yes, to stabilize the highly volatile uranium business long-term.
Okay, but that sounds like a massive global undertaking. It must require a tremendous amount of investment.
Which brings us to the balance sheet. They've made some historic moves lately.
The balance sheet strength is, I think, key to the entire thesis. In October 2025, they executed a massive capital infusion. They priced $700 million in 0.75% convertible senior notes.
And it was oversubscribed.
Heavily.
Yeah.
The fact that it was oversubscribed by institutional investors, well, it speaks volumes about confidence in their strategy.
Okay, let's unpack that for a moment, because convertible senior notes at 0.75% interest in this environment sounds like financial wizardry. Can you simplify what this means?
Sure. It is essentially very cheap long-term financing. Convertible notes are debt that can, under certain conditions, usually if the stock price goes up a lot, be converted into shares.
So it's a win-win.
The benefit is twofold. Securing debt at just 0.75% is incredibly low, minimal drag on cash flow. And securing $700 million means they have serious dry powder to execute their plan without having to, dilute shareholders right now. So they're funding this huge global expansion with nearly $1 billion in working capital and minimal long-term debt. That's a strong position.
An incredibly strong position. It gives them flexibility. However, while the capital structure is fantastic, the recent earnings picture has been, it's been mixed, and this is where investors need to manage their expectations.
Walk us through those mixed signals. I saw a solid trailing 12 months revenue, about $78.74 million, and management actually raised full-year guidance to between $125 and $140 million. That sounds good.
It is positive, and their weighted average uranium production cost is low, around $53 a pound, which ensures good margins. The caution comes in two forms. First, Q3 2025 EPS actually missed analyst expectations.
Okay.
And second, the consensus view suggests a near-term year-over-year revenue decline of almost 40% in 2025.
Whoa. A 40% decline. I mean, that would send shivers down an investor's spine if they didn't know the full story. Why such a steep projected drop?
Right. And this isn't necessarily demand destruction. It's more a known projection of volatility. It could be driven by inventory management, contract phasing. Maybe they're holding back inventory, or they're just between major delivery contracts.
So it's a timing issue.
It's a timing issue. And the critical point is that the market is projecting this short-term weakness will be followed by a truly massive, estimated 85% revenue rebound in 2026.
So you have to be prepared to look past the next couple of quarters and focus entirely on the delivery of that 2026 growth story.
Precisely. And that brings us to corporate activity and upcoming catalysts. We have seen some shuffling in governance. Director Robert Kirkwood resigned back in October.
But that was balanced by an important promotion, right? The elevation of Ras Arbapu to president. Does that signal continuity?
It strongly suggests continuity, yes. Fapu is known to be strategically aligned with the diversification into critical minerals, so his promotion really reinforces that commitment to the multi-commodity pivot.
What about insider selling? We saw a planned sale of about 150,000 shares in August.
We did. It was worth about $2.3 million. And while you always need to monitor those things, it's important not to overinterpret a single planned sale, especially when you see modest but steady institutional accumulation in the background.
Right. Big money coming in after they secured that growth capital.
Exactly.
Okay, so let's pivot to the catalysts. What are the key dates and events you should have marked on your calendar?
So we have three types of triggers coming up. First is institutional flow. December brings the Uranium ETF quarterly rebalancing and the S&P ETF rebalancing.
And those can force big funds to buy or sell, creating volatility.
Significant short-term liquidity, yes.
Yeah.
Then after the new year, January and February, we get the institutional 13F filings.
Which is when we get to see the report cards. We see which big hedge funds have been buying in.
Right. It can be a huge validation point if we see major names appear on that list. And then, of course, financially, all eyes must be on the end-of-year results.
The Q4 2025 earnings release.
Yes, expected in January or February 2026. This is critical. It's the first report where management will have to give concrete color on how they're deploying that $700 million.
And operationally, we're waiting for proof on the diversification plan.
Correct. We anticipate updates on the Phase 2 rare earth separation progress at White Mesa. Every milestone they hit there de-risks the whole strategy.
Okay, let's turn to the technicals. What's the chart telling us?
Well, the long-term trend remains fundamentally bullish, which, isn't surprising given the strategic tailwinds. The stock is trading comfortably above its 200-day moving average, which is supportive, around $11.09.
But we have seen a noticeable pullback recently. It dipped below the 50-day moving average, which is up around $17.72. What does that suggest?
That pullback suggests a midterm correction is underway. It's likely fueled by some profit-taking after the big note announcement and nervousness about that short-term revenue forecast we just talked about.
So what's the trading range to watch?
The anticipated range for the next 3 months, barring a major catalyst, is likely between $12 on the support side and $18 as resistance.
And what about momentum? Is the stock running out of steam or just getting ready for the next leg up?
The Relative Strength Index, the RSI, is sitting at 33.58. This is significant because it indicates the stock is not oversold, but it has corrected enough that it provides, I think, a constructive entry point. It suggests accumulation is happening post-correction.
Giving it plenty of room to run upward once a catalyst hits.
Exactly, without it immediately hitting overbought territory.
Right. Let's move to the most speculative part of our discussion. Market chatter. The rumors.
There are persistent rumors, yes, especially around that rare earth pivot. One major area of speculation involves a processing or an offtake partnership with a major global rare earth player.
Which would be huge. It would immediately de-risk that whole revenue forecast for the expansion.
It would. And then, given the U.S. government's push for domestic supply, contract speculation is always high.
Department of Energy contracts.
There's continued speculation they are in line for new DOE contract awards for domestic uranium. Any definitive announcement there would be massive. And finally, M&A.
Is this company a target?
The chatter suggests yes. It's fueled partly by the strategic value of White Mesa. Unconfirmed reports hint that larger energy or resource companies are showing interest precisely because this company controls a unique, federally licensed, irreplaceable domestic asset.
Okay, so let's tie this all together.
To synthesize everything for you, Energy Fuels is in the middle of a strategic and financial metamorphosis. It's using a massive cash position secured at incredible rates to transition from a pure uranium producer to a diversified critical minerals platform.
And it's all happening with this powerful tailwind from U.S. government policy.
Absolutely.
So the fundamental risk here isn't necessarily demand, it's really about execution. You have to be willing to look past that projected 2025 revenue dip and bet on the explosive 2026 growth forecast. The question is, can they pull it off?
It's a growth story backed by nearly $1 billion, but that money has to translate into production. The outcome really hinges on the success of that Phase 2 expansion at White Mesa and the development of those international projects.
Here's the final thought for you to chew on. Think about the structural support from the U.S. government regarding critical minerals and domestic energy security. How does that policy tailwind fundamentally change the long-term risk profile for this stock?
It's a compelling point.
When a company controls an asset deemed crucial for national security, it really shifts the investment thesis from a pure commodity speculation to a strategic, policy-backed growth play over the next 12 to 24 months.
A very compelling structural argument indeed.
If you found our analysis useful, remember to subscribe and leave us a comment. We appreciate the support, and we'll catch you on the next deep dive.